Welcome to the deep dive. We're here to, cut through the noise and really focus on the insights that matter. And today, we're doing a really fascinating deep dive. It's all about a concept that's genuinely changed how a lot of people think about investing. It comes from this, well, small but really powerful book, Joel Greenblatt's The Little Book That Still Beats the Market. It's just so influential, I think, because it takes something that feels super complex, like consistently beating the market, and makes it, well, surprisingly simple. So, our mission today, our goal for this deep dive is pretty clear. We want to pull out the most potent, the most actionable ideas from Greenblatt's work. We'll be digging into what real value investing is all about, kind of unraveling his magic formula, why it actually works, and also tackling that psychological side, why it's so hard to stick with a winning strategy sometimes. And then finally, thinking about how even, say, active traders might be able to use these ideas.
Exactly. And that's really the point of this for you listening. Think of this as your shortcut, your way to get properly informed about a strategy that has, time and again shown it can outperform. We're aiming for those like surprising facts, those aha moments that might make you rethink things a bit, give you an edge without having to sift through, heaps of financial jargon.
Okay, so let's unpack this then, because I think when most people think beat the market, their mind goes straight to like complex algorithms, right? Or maybe high frequency trading, super fast computers, or maybe even some kind of, I don't know, insider knowledge. There's this idea that you need serious complexity, like an arms race. But Greenblatt kind of turns that on its head.
He totally does. And it's frankly one of the most compelling arguments he makes. Greenblatt basically says complexity. That's the enemy of consistency. He really champions these simple rule-based systems.
Oh, why?
Because they just perform better over time than decisions based on gut feelings or emotions. Our emotions, well, they're pretty terrible guides for investing, aren't they? We get greedy, buy high, we get scared, sell low.
Yeah, the classic mistakes.
Right. And the beauty of his magic formula is just how simple it is. Like you said, it boils stock picking down to just two core ideas. Anyone can grasp these. First up, you got earnings yield. Now, okay, it sounds a bit technical maybe.
Yeah.
But just think of it as how cheap is this stock compared to the profit the company's making? It's like for every dollar you put into the stock, how much profit are you getting back? We're looking for companies that are genuinely cheap relative to their earnings power.
Okay, cheap compared to profits. Got it.
Then the second piece is return on capital. This one tells us how good the company is at actually using its money, its assets, its earnings it keeps to make more profit. It's basically a measure of like how efficient the business is. High return on capital means the company is great at turning its resources into profit. So really, we're looking for two things. A great company, and we want to buy it when it's on sale.
That combination, yeah, it just clicks when you put it like that. And he has that great analogy in the book, doesn't he, about buying a luxury car, a really top quality machine, but somehow finding it at a massive discount. It's like getting the best of both worlds. And when you put those together, quality companies, cheap price, you're really stacking the deck in your favor. It's an edge that just grows over time, right?
Yeah.
Through compounding.
Exactly. And this focus on keeping it simple, it's not just for the buy and hold crowd. It's huge for active traders too. Because it tackles that thing we call analysis paralysis head on.
Oh, yeah, I know that feeling.
Right. You're just flooded with indicators, news, opinions, and you just freeze. Can't make a call. It's like that massive restaurant menu. You just end up ordering water.
Yeah.
Greenblatt's lesson is crystal clear. Simpler rules you can actually follow consistently, lead to better results in the long run because you actually do them instead of just thinking about them endlessly.
Okay, so we get the ingredients, cheap stocks, good companies making profits efficiently. But the bit people always want to know is, how does he actually say to put it together? What are the practical steps for this magic formula?
Right, the how-to. And again, it's remarkably straightforward. That's part of the magic, really.
Yeah.
You start with a list of companies, usually bigger ones, established businesses. Then you rank every single one based on those two factors we just talked about.
Earnings yield and return on capital.
Exactly. You give each company a rank for earnings yield, #1 is the cheapest, and a rank for return on capital, #1 is the most efficient. Then you just combine those two ranks. Add them up, basically, to get one overall magic formula rank for each company.
Simple enough.
And then the investing part is dead simple.
Yeah.
You buy a basket of the top-ranked companies. Greenblatt usually suggests maybe 20 or 30 of them. Diversification. You hold them for 1 year. Exactly 1 year.
Okay.
And at the end of the year, you rebalance. Sell the ones that aren't top-ranked anymore. Buy the new ones that have moved up the list. That's it. No market timing, no fancy software needed,
Yeah.
just discipline and that annual check-in.
So, a big part of the appeal must be what you don't have to do.
Absolutely.
No trying to predict the economy, no staying glued to the news all night, no trying to figure out what the Fed's going to do next. You just follow the process systematically. That must take a huge weight off, emotionally speaking.
It really does. That's a massive part of it. Which leads to the next question, right? It's just about cold, hard numbers. Why does this actually work?
Yeah, why isn't everyone doing it if it's that simple and effective? Why does the market leave these opportunities lying around?
Well, the market isn't perfectly efficient or rational, not even close. It's driven by people, and people are driven by emotions, fear and greed, mostly. People overreact all the time to short term news, good or bad.
Like a bad earnings report sending a stock down way too much.
Precisely. That company drops 15%, maybe 20%,
Yeah.
just because earnings were slightly off expectations. Even if the long term picture is still great, the business is still solid. That's emotion. The magic formula finds those companies systematically. Good, profitable businesses that are just temporarily on sale because everyone else is panicking or just looking at the next quarter, not the next 5 years.
So it exploits those temporary mispricings.
Exactly. And the proof is in the pudding, as they say. The historical performance data in the book and other studies too consistently show this approach beating the market averages significantly over the long haul. It works because it takes advantage of those behavioral quirks, those moments when other investors are being emotional or short-sighted.
Okay, so it works historically, it's simple. Which brings us to the $1 million question, the big catch.
Ah, yes.
The catch. If it's this good, why isn't every single person doing it? There must be a downside, a hidden difficulty.
There is. And it's not in the formula itself. It's in us. It's psychological. The biggest challenge, the absolute toughest part, is patience. Discipline. Because this strategy, it will underperform sometimes. It might lag the market for months, maybe even a whole year or longer in rare cases.
Yeah.
And that's the point where most people give up. They want results now. They see the strategy lagging, they lose faith, their discipline crumbles.
Guys bail out just before it potentially turns around.
Exactly. They jump ship right when sticking with it is most crucial, just before it often snaps back and starts outperforming again. And that's such a vital lesson, not just for investors, for traders too. Your biggest edge, it's not your system, it's your discipline. Systems usually fail because people stop following them, especially when things get uncomfortable during those drawdowns. Sticking to the plan, especially when it's hard, that's the real superpower.
Yeah.
So this really poses a question directly to you listening right now. Can you really trust a proven system, even when it's not working in the short term? Can you handle seeing your portfolio maybe trail the S&P 500 for a while, knowing that the long-term data supports the approach? If you can honestly say yes, well, you're already way ahead of the game.
Okay, so thinking about the listeners, maybe some identify more as active traders, day traders, swing traders. What does this all mean for them? How can they take this magic formula mindset and apply it?
Yeah, great question. Because it's not just about buying and holding for years. The core takeaway for traders is shifting to a mindset of process over prediction.
Process over prediction. I like that.
Trading can so easily become about chasing the latest news, reacting to every little market wiggle, always trying to guess the next big move. Greenblatt's whole philosophy pushes against that. It tells us a disciplined, repeatable process you stick to is far more reliable than trying to be a psychic.
So for a trader, what might that look like in practice?
It could mean having really strict rules for entering and exiting trades. Maybe you only trade breakouts above a certain moving average with a fixed stop loss and profit target. And the key is you never break those rules. No matter what the news says, no matter what your gut feeling is telling you, develop simple, clear rules for your style of trading. And then find the discipline, that word again, to follow them religiously. Don't fall into the trap of always tweaking, always searching for the perfect setup that never quite exists. Build a solid strategy, whatever it is that you know you can execute consistently, even when the market's choppy. Consistency wins.
And thinking practically too, even if you are an active trader, focus on the short term. You could still use the actual magic formula for a portion of your capital, right? For the long-term part of your wealth building.
Absolutely. That's a really smart approach.
Yeah.
Use the magic formula for, say, your retirement account or a long-term investment pot. It's systematic, it's proven over time, and honestly, it takes very little effort compared to active trading. Maybe an hour to a year to rebalance. So you get that solid, low-maintenance foundation growing while you still pursue your more active strategies with another part of your portfolio. Best of both worlds, really.
So wrapping things up from our deep dive today, it feels like we've hit on some really Crucial takeaways for anyone in the markets. First, simplicity wins. Don't overcomplicate things. Complexity often just hurts your returns.
Yeah, keep it focused.
Second, have rules. Clear, objective systems protect you from your own emotional biases. Big time.
Crucial.
Third, be patient. This is maybe the hardest one. You've got to stick with good strategies even when they're temporarily out of favor.
The long game.
And finally, think long term. Even if you trade actively, have a plan for strategic long term wealth growth. Don't just focus on the next tick.
Definitely. Build that future.
Joel Greenblatt's little book, it really is packed with enormous wisdom, isn't it? Just profound insights for building wealth and maybe even just finding clarity in finance.
It truly is. And maybe, just to leave you with one final thought to mull over. Yeah. Think about this. Beyond just investing, where else in your life could you apply this idea? Where could embracing simple rules, discipline, and a long-term view help you navigate complexity? What could be your own magic formula for success? Whether it's in your career, your health, your relationships, how can you find more clarity and consistency in this often chaotic world? Something to think about long after you stop listening today.